Hey everyone, it's Brady Webb, American Mortgage Solutions. I'm a mortgage broker in Kentucky, Florida, Indiana, and Tennessee. So I'm here today to try to explain to you or put some information out there and explain in layman's terms what's going on with this current market and kind of the mortgage crisis that we're in and some of the unintended consequences that the Federal Reserve has caused. So bear with me because I am not an economist. I do understand the mortgage business. I'm not 100% an expert on how everything works behind the scenes, but I do have a decent knowledge of that. So I want to share that with you because there's a lot of misinformation going on. There's a lot of concern, and I just want to try to explain to everybody what's going on. So I'm actually got a couple screens going here. I'm going to do some screen shares. I've actually whiteboarded some stuff out on paper for you that I'm going to go through. So bear with me. I'll try not to take too much time, but it'll take just a minute to explain this to you. So first of all, let me explain, the Fed dropped rates a couple weeks ago. I guess it's been a couple weeks now. And they came out with that announcement on a Sunday that they're going to cut rates to zero. Well, a lot of people, they didn't do a very good job of explaining what that meant. And actually, they cut rates to zero for the banks. It's a Fed funds rate. That's what the banks lend money to each other at. That's not what you can get a mortgage loan for. And, I wish they'd do a better job explaining that because a lot of people immediately think you're getting a zero. Now you can get a zero rate mortgage or you can get a zero rate credit card or line of credit. That's not the case. So anyhow, when they did that, I'm going to share my screen here with you. I'm going to kind of show you what's going on here with everything. So give me 1 second to get the right screen up. And so this is kind of like a little whiteboarding exercise I did. So to kind of put all this into perspective, what's going on in the market and why we're kind of in a mini crisis right now, because you're going to start hearing next week that a lot of the government programs are going to change drastically, and they're trying to keep them from going away or pausing because Ginnie Mae, who's the biggest purchaser of these government programs, not that I don't know that they're in trouble, but a lot of these servicers that service the Ginnie Mae products are struggling because of margin calls and the lack of liquidity because servicing values have been cut in some cases by half. So this little diagram here, so these are like all the people that are wanting to buy houses or in the process of buying houses. And then as they go through the process and they close on their loan, they become a homeowner right here. So now they're a homeowner, and what happens with that mortgage loan, it gets sold off to a servicer, which is this guy right here in the middle. And what the servicer does, that's the person that actually mails you a statement each month, answers the questions about your loan, they collect your payment, they separate your taxes and insurance and mortgage insurance if you have it out, and they just make sure everything gets to the appropriate place. And then once a year, they do an analysis. If you have a mortgage loan, you're going to know that you get a mortgage analysis or escrow analysis each year. It kind of shows you what your balance is and whether they need to adjust it or not. So that's what the servicer does. Now, this guy over here to the right, the investor, is the guy that's actually has all the money and is actually put out the money to make sure the Mr. Homeowner gets a loan and the servicer services it and takes care of it. Now, then the next player is there's an aggregator in this right here. And again, I'm not an expert at this, but there's an aggregator that these investors send the loans to, and they create what's called mortgage-backed securities. They're investments. Those investments show up in your 401k, annuities, and anything else your financial planner or your company that has you in a retirement account, they're probably buying some mortgage-backed securities. So those loans are sold, and they're in this investment right here. Now, this is what happened when the Fed started cutting rates. If you remember a couple weeks ago, before the Fed even started cutting rates, the rates had dropped because the market ran off. And so the money flowed over to the mortgage-backed securities, these guys right here. They were buying them for a safer investment. Well, when that happens, interest rates drop because that price goes up and the interest rates start dropping. Then we got a lot of people wanting to refinance because rates were dropping. So our lenders, their pipelines filled up. Now, again, I might be jumping around a little bit, but just bear with me. I'm going to try to hopefully put this in perspective with you. And then the federal government came in because everything continued to basically unravel in the stock market and the mortgage-backed security market, and the Fed jumped in and dropped rates. And then they also announced as they dropped rates, they're going to start buying mortgage-backed securities, which they've actually increased the amount that they're buying, or the frequency and dollar amount that they're buying over what they actually announced. Now, as they do that, that puts pressure on the rates to go down even further, which here's what's going on now. These guys right here, these servicers, they pay to have the right to earn money off of servicing your loan. They pay about 1 point or 100 basis points of the loan amount, and they service billions. I got it over here. I'll get to that in a minute. But these guys, depending on who the servicer is, I mean, they're servicing billions of dollars of mortgages. So they're paying about 1% or 100 basis points to earn about 30 basis points a year on that business. Now, think about that. So that's roughly a third. So it's going to take them about 3 years to recover the cost of what they paid to service that loan. So think about that. If you paid 1 point to service something, or you say you paid 1 point on an investment, and it was going to take you 3 years to break even, then you start making money. What happens if it starts getting paid off? Because people are refinancing early. Then you're basically losing money. And what's happening is, because so many loans are getting paid off so fast within this 3-year period, it's causing basically an accelerated payment of these mortgage or these loans, and the servicing value is getting cut in half of most of these servicing companies, and they're having margin calls. And that's something totally separate than also the defaults, because now we have 3 million people right now unemployed. Now, how are these 3 million people going to make their payment? Now, here's the other thing about servicing, which is going to make more sense when I get to the FHA kind of crisis we're getting ready to go through with the government stuff, FHA, VA, USDA loans. These servicers right here, if these 3 million people default on their loan, and a lot of these people are homeowners. Some of them are going to be renters, but a lot of them homeowners. They start not making their payment. This servicer still has to make the payment to the investor. They have to make the investor whole. But the investor has to make the mortgage-backed securities whole. So these guys have to pay these guys. So here's what's going on. So Fannie and Freddie, they're on the hook for one payment. On Ginnie Mae, which is USDA, VA, and FHA, they're on the hook for every single payment. So just think about that. Just think about that. If that payment on that loan's $2,000 a month, they're going to make that payment every single month. That borrower doesn't make it every month. So if you're servicing billions of dollars of loans, just think how much money that is. So they don't wait for their money. They're like, hey, you need to pay me now. So if they're $5 million short, $20 million short, $50 million short, they got to write a check, send it to them. So what's happening is the servicing guys are like, well, we don't want any more loans. Stop. And now that the stimulus packages came out, which is good, but again, this wasn't thought through real well, because they allowed, I believe, they have allowed for like up to a deferment of 4 payments. And I could be wrong, so if I am, please correct me. But I know there's a provision in there saying, hey, you can't make your mortgage payment or your rent payment, then you basically are going to get some leniency. We'll put it at the end, or we're going to give you, basically cut you a break. But guess what? The servicers don't get that same break. So they have to keep making payments. So what's going to happen? Obviously, you run out of money, and you got to say, well, don't want any more. So the mortgage business basically either stops, or they increase the requirements to where they're only taking the very best borrowers. And so that's now the mortgage industry is contracting. It's becoming more difficult to get it approved, and you're actually seeing loan programs disappear from the market. This past week, what we call the non-QM, starting last week, this week, non-QM, which is the non-qualified mortgage, is the programs like bank statements, asset depletion, investor cash flow programs. It's basically the creative programs where people should be able to borrow money that don't fit into the square peg and the square hole. Those programs have completely left the market. They're completely paused at this point in time because there's no appetite on Wall Street for them. The other thing you're going to see disappear, and it's starting as basically already disappeared, is the jumbo loan. So anything over that FHA conforming loan limit, which is in the 500s, that market's gone away as well. Now what you're seeing is because Ginnie Mae, the servicer's on the hook to make every single payment on any government loan. All the investors now are pulling back, and all the credit score requirements have come from 580 up to 640 as of Friday, and they could go even higher, which means that's less people that are going to be able to qualify to buy a home. Now, how do we get out of this? Right now, again, I mentioned earlier how when the rates dropped a couple of weeks ago, the investors basically took in about 90 days worth of volume in about 3 days. So there's only so many people these investors have to work. So there's a capacity issue. They got to get through that glut of business, get it off their books. And then the other thing too, with the Fed continuing to buy and trying to push the rates back down, these people are in these pipelines are saying, wait a minute, I can get a lower rate over here. And so every time that they maybe stop the loan over here and go over here, that investor that locked that loan is still on the hook for that lock agreement. So that creates problems. But as the volatility in the market goes up and down every single day, these investors also have a very difficult time hedging their pipeline or their locks. So as we lock loans, they try to hedge it, protect them from the downside. And if they're not able to do that because it's so volatile, then they're getting hit with margin calls based on the locks and the hedging. So it's a very difficult time in the mortgage industry right now. Now, here's how this affects us as home buyers, borrowers, maybe wanting to refinance, realtors, our referral partners. Let's talk about that. So one, requirements are going to go up because the investors, until we can get all this, best thing to do, the Fed could actually, if they could just stop buying mortgage bonds for just a second and let everything move off the pipe that's already in there. Let's get it out of the pipeline, quit creating more issues with hedging, quit costing these lenders millions of dollars trying to pay these hedge fees because it's so volatile and pushing rates. Because you know what? If they've got loans locked at 3.5%, 4%, and they keep pushing rates down, they're just devaluing all that. So it's best they just let everything run off, and then they can start buying securities. But here's where I think we are short term going forward. You're going to see a tightening of guidelines. So FHA, VA, USD score requirements are going to be 640 as of tomorrow. That's pretty much a given. You're probably going to see some changes on the conventional side as well. Loan to values probably won't change, but DTI, which is the debt to income percentage, this amount of debt that you have compared to your income. We used to be able to get loans approved up to 56% on the FHA side. That's going to be capped at 50% now. It's going to go 50, and it could even go lower. So that's going to mean less people qualify for a loan. One, based on credit score, two, based on debt to income ratio. So we're going to have fewer people that are going to qualify. Now, if if you're listening to this and you're one of our referral partners or you're a realtor and you have clients out there that are shopping for homes, you need to make sure what their qualifications are before you start writing the contract. Because whatever it was a week ago or even a month ago, we have clients that we've pre-approved months ago, and we need to go back and look at all those. And just to make sure before they're out there shopping for a house and maybe they got a 630 score before tomorrow, that was great. Now that's not going to work. So we don't want people out there homeless. I've had enough of that going on over the last couple of weeks with these changes. And I tell you what, just like the non-QM stuff, when they were finished, they were finished. It didn't matter where they were in the process. If because that market evaporated, these people were left with nothing, even though they could almost been complete and ready to close, and there was no money, so deal's off. It's a shame, but anyway, if you have any questions, call me. But if you have buyers right now that are in the process of getting the right contracts, please make sure that everything's good. Now, as a realtor, you can only, the lenders can only give out certain information because of privacy. But call your lender and ask and make sure that the program they have them approved for is still available. Because the worst thing you do is go out there and spend money on appraisals, home inspections, and money's tight now and things are tough. We don't want to waste anybody's money, so let's make sure that the program that they're approved for is still good, that we can still execute and close that thing. And let's just, it's just a different time right now. This is all going to pass. It's going to get better. We just got to let things settle down, get the coronavirus behind us. Hopefully that starts subsiding some in the next weeks, the month, and then as our markets continue to, I guess, digest what's going on, they're going to come back as well. And we do have a very healthy real estate. We had a very healthy real estate market before any of this happened. So as soon as all this starts getting through the system, it's going to come back and it's going to be healthy again. Because really, there's not anything wrong with our real estate industry, or as far as the mortgage industry, it was pretty daggone solid and everything was moving along nice and smooth. And we just had basically the perfect storm that created this issue. And a lot of it is to do around, the servicers, and they're just getting crushed right now with margin calls and, the portfolio. It's just everything's going on between the refinances, the rates being lower. Now we got high unemployment. So it's kind of the perfect storm in a bad way for them. But I'm here to help in any way I can, answer any questions I can for your clients, my realtors, any realtors out there that want to talk to me. I plan on trying to hold, since we're kind of all trying to stay away from each other and doing, whatever we call it, happy at home, self or social distancing, shelter in place. There's a lot of different words out there. I'd like to start holding maybe our own little happy hour once a week, and we'll just do it on a Zoom meeting. We can all get together and talk about what's going on and just relax, get to see each other, chat. So plan on starting that this week. But if you guys have any questions whatsoever, reach out to me anytime. Hopefully this was helpful. And, again, I'm not an economist, so I explained it as best I can, but hopefully it makes some sense to you. Again, have an awesome day. Stay safe, and I'll talk to you soon.